Hello, YouTube. The stage is set for an explosive move on the S&P to either re-advance to previous all-time highs or to retest the October lows from about a year ago. This will be very important, so please make sure you stay tuned till the end of the video so you can get all the commentary on how to prepare for next week. We can also note that the S&P is now closing below the 200-day moving average for the first time, and the market is very red in the last month. It's also very red in the last week, and it's also very red today. So what does that mean? It means that we're back in fear and we're on the doorstep of going back down into extreme fear. This is at a time when seasonality might be starting to kick in, or this time might be different and we go for a massive crash. So I'm going to go through this scenario exactly. We can note here and see that the seasonality chart knows that we should be getting a 1-2 cut, a monster dead cat bounce, and then a lower low. Well, that's exactly what we got. I got to thank one of the viewers from the Friday stream who pointed this out. We're a little bit delayed. This would normally happen into the second week of October, and we're now going into the third and last week of October. So we're going to go back and review that. I do have some specific commentary as it relates to the 200-day moving average, so please make sure you stay tuned for that. And this is also important because the S&P is now currently below the previous monthly low with a lower high and a lower low for 3 consecutive candles. We're stopping to go up, and here on the weekly chart, it's not looking all that great. Bearish engulfing weekly candle. The bears are taking control. Volume is elevated here on the daily chart as we decline. So increasing volume as we decrease is a classic bear signal. That's not what we want to see. And then finally, we have another level of support at 41751. That's going to be our 50 weekly moving average. And this is going to correspond with roughly the 50% retracement or the half yard line between the all-time high and the October low or the bear market bottom. Final thing to remember is that roughly 10% off the top is going to be about 413. So if we're looking for another target to hit, I would say we're looking for roughly 417, 414. That's the areas I'm looking for. If that doesn't hold, well, we could be heading down to 400 or the 38% Fibonacci area. And finally, we're looking for about 386, which would be our 50 monthly moving average. All right, we got a lot on the docket for the show today, so let's go through. We can note that short sellers are actually covering again this week. They're now down to only 63,000 net short contracts, which is the lowest level we've actually seen since the bear market began all the way back in June of 2022. Are they going to go net long? We've joked about this a few times before, but they go short, double down, then they go net long. We go back to 2015, they short, double down, then they go net long. That would be bullish if it happens. Something that's really interesting to me too is that we've been talking about how strong the economy is, and we're going to get that preliminary GDP print coming out this week. So, well, 41% of Americans actually say that higher interest rates have no effect on their finances. I find that particularly interesting. It could explain part of the reason why we're seeing the GDP now from the St. Louis Fed currently forecasting 5.41% for the third quarter. That is incredibly, incredibly strong. We also have earnings coming out this week, notably from Coca-Cola, Microsoft, Alphabet, Meta, and Amazon. We got the big dog Apple coming out November 2nd. We also have a few other things this week. We've got Jerome Powell speaking on Wednesday at 4:35 p.m. We've got preliminary Q3 GDP coming out on Thursday. That's going to be at 8:30. And note the numbers here, 4.1%. That's a little bit lower than the number we have on the GDP now from the St. Louis Fed, but still very, very strong. Finally, if we look forward to the Friday number, core PCE, month over month and year over year will be coming in. We're expecting to see an increase on the month over month to 0.3, but a decrease on the year over year down to 3.7. This is an estimate. I'm not sure it's actually in the forecast yet. So what I find interesting here is that GDP is going to be at 4.1, but inflation is at 3.7. That's called productivity gains. That's exactly what the Fed wants to see. I'm going to ask you for a huge favor before we go further. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really appreciate that. And I'll thank you ahead of time. Thank you so much. All right, so seasonality, we got all these earnings coming up, and we're going to go through each one of these in a moment. We're going to look at each one of these stocks. We're going to try to understand what it means for the market. But let's just go through and make sure we understand the rest of what's important for this week. All right, Jerome Powell is going to be speaking on Wednesday the 25th at 4:35 p.m., providing introductory remarks somewhere in Washington, D.C. But this is not going to be monetary policy related because the Fed is actually now inside of a blackout period as of right now, which means they're not allowed to discuss monetary policy. Between October 21st and November 2nd, the Fed cannot discuss monetary policy. So we're not likely going to see much of a move from Jerome, but he might surprise us, right? He might, maybe, I'm not quite sure, but let's just make sure we pay attention to that date, because after that, we've got the Fed coming in on November 1st for the interest rate decision. This meeting will not be associated with the SEP or the Summary of Economic Projections, but it's going to be a very important meeting. We want to know if it's live, meaning, is he going to raise interest rates? Is he going to pause? And is he going to say anything about what we're expecting for December? There's the asterisks here. So the reason why these dates are important is because we're going to be getting the economic data coming out earlier in the week. So if we go through the, let me just see if I can pull up that image again, because I just want to walk you through the different dates here. So if we go through and see first half of the week, nothing on Monday or Tuesday in terms of economic data. Jerome Powell talks after the market close on Wednesday. If we now have a look here at our earnings calendar, we're going to be getting Coca-Cola, Microsoft, Alphabet before Wednesday. Then we've got Meta coming out after the bell on Wednesday. Then we got Amazon on Thursday. And then we got Apple coming out on November 2nd. So Apple's going to be coming out the day after the Fed. So if we think about all this, what's been driving the market lately? Well, it's been a lot to do with interest rates. So a lot to do with interest rates, but I think the market's going to really focus on earnings kicking off with big tech really set to lead. The reason why this is also important is because we know that we were expecting, let me just see if I can pull this up here, 1 second. If we have a look here to the seasonality chart, what could actually drive this higher? There's a few things. I'll talk about what could drive it higher. I'll talk about what could drive it lower. But I think that right now we have to think about expectations as it relates to Q3 profit growth from the S&P 500. The big five is where we're expecting the most growth. So financials have delivered. Energy is kind of sucky right now, but the big five are going to be largely reporting this week. We've got 1, 2, 3, 4 out of the group. 4 out of the Magnificent 7, not the Magnificent 5, right? We're excluding NVIDIA, which reports sometime in November. So if tech delivers, fantastic. Maybe the earnings recession is over. If tech does not deliver, oh my goodness, we could be headed for a big fat fade. That's why we're looking here at the monthly chart and talking about downside targets as low as 386. All right, there's a lot for us to go through. So hopefully you're enjoying the show so far. Now that we understand the backdrop of what we're looking for in expectations and how all these individual dates are going to line up, we're going to see whether or not we can formulate a plan if we're bullish or bearish to try to get prepared for this. Because this number right here coming in on Thursday, I think it's going to be very important. It's a preliminary print. Everyone's been talking about how the economy is strong and resilient. I think this will be some confirmation for us. We also want to pay attention to the ECB rate decision, but it's less important in my opinion. And then initial jobless claims will also be important. I think that rounding out the week with core PCE, whether it's good or bad, we have to watch for the reaction. When I look at these numbers here, I would expect GDP to be received positively. I would expect the headline number for month over month to be interpreted as bearish because it's going to be going from 0.1 to 0.3. But the most important number that Jerome pays attention to is 3.7. If it comes in there, I think the net effect will be that it's actually positive. And I'll show you one more thing here, which is actually very interesting if we think about what Jerome and the Fed have told us about that sufficiently restrictive, because they've used this word many, many, many times now. They talked about 1.5 to 1.6% for it to be sufficiently restrictive over the core PCE number. So if we grab a calculator here and we go to the official website for the Fed, we're going to the Fred St. Louis Organization for the Fed Funds. We can look right over here and note that the Fed funds is currently at 5.33. And then we take the rate of inflation, which is currently 3.7. So we go 5.33 minus 3.7, and that gives us 1.63. That is sufficiently restrictive. It's over 1.5. It's over 1.6. This assumes that we're going to be coming in at 3.7, though. If we do not, all bets are off. Same thing with the earnings from this week. And yes, I'm Captain Flip Flopper. I flipped this week because after we hit a new low of the week, which I was not expecting, we definitely saw the pain train come to fruition here. So what I want to focus on now is a couple of charts. Actually, no, I got to go through here first. So hopefully you can stay tuned till the end of the video. I think I'm going to deliver you a nice plan for the week if you're bullish or bearish. And I'm trying to be as objective as possible. But of course, I do have a bias. And if that's not clear, I still think we're going up. But I'll tell you exactly what I want to see to know that I'm wrong this week. All right, so earnings. What are we expecting for earnings? We're going to go through in order. So Coke, Microsoft, Alphabet, Meta, Amazon, and then Apple last. What do we got? we're expecting a 2-cent beat from Coca-Cola. All right. Pepsi already reported, and they said things were pretty good. They were able to pass on prices to consumers. Microsoft expecting a beat, 269 over 265. It's not a huge beat. If we go 269 divided by 265, it's not that big. It's a beat of about 1.5%. So I think for Microsoft, it's going to come down to guidance, right? That's what I think it's going to come down to. Then we look to Alphabet. Alphabet's expecting a better beat, 154 over 145. I think that's going to be interpreted a little bit more bullish. If you look here to Visa, we're expecting a beat of about 4 cents. That's an important company too. I threw that into the mix. Then we can look here at Meta, 366 over 357. So as the week progresses, it looks like earnings are getting better. So that's good. And remember, this is just before Jerome Powell talks, but we're likely not going to see monetary policy. Now we've got Amazon coming in 65 over 58. This is the best one yet. So this one's expecting an EPS beat of 12%. That would be the best out of the group so far. We don't see a single miss forecasted either, by the way. It was only stinky Tesla on their conference call that actually tanked the stock. And then finally, we got the biggest stock in the entire market, Apple, the king, coming in on November 2nd, the day after Jerome. So I think this is either going to help the move or it's going to contradict the move, meaning if we're going down, maybe this makes us go down more. If we're going up or down, maybe it does the opposite. Of course, we can go up, down, or sideways, as I tell you every single video. So here we're expecting a beat of about 4%. This would actually be more constructive than Microsoft. So I think we'll have to pay attention to it. There's some concerns about Apple's forward guidance, but Q4 is usually their best quarter of the year because people like to buy stuff going back for school and then also for Christmas presents. All right, so we got through a lot of data so far. And now we're going to talk about the specific trade plan, and we'll finish off by looking at a few more charts. So so first thing I want to caveat here by saying is that we're already here at October 21st. So if we're currently expecting the seasonality move to happen, it's a little bit behind. It's a little bit delayed, which means that we're looking to know whether or not this is close enough or if it's not. So we can look here. Let me see if I can actually zoom into the period we're looking at. Let me just try to do this really fast here. And we're going to go to a line chart because then we can actually see what's happening. We're going to click out. And now we can actually see the line over top here. So let me just see if I can get it a little bit closer. There we go. So it's not been perfect. We can note over here that we're going up as we go lower. Same thing here. We're going up as we go down. So it's not like this is like a guarantee. It doesn't mean we have to go higher. Same thing here. We deviate by going higher when we're supposed to go lower. But the Santa Claus rally in the last 3 months of the year are the most bullish time. We're supposed to go straight up. So how can that happen? We're currently in fear. We buy that. We're currently got measles in the sky, so it might be time to buy. And then technically here, we've had our one cut, dead cat bounce, second cut to a lower low. And the challenge here, now I'm gonna go through, make this very clear. I'm gonna go bull thesis. Make sure you guys understand that I'm laying out the bull thesis now. And this is my base case, by the way. So the bull thesis is that we're just going to go straight up from here. Monday, I think the last 12 Mondays have been green. If this time's going to be the same, we should be starting that nonstop up, where we just go straight higher. What would this do? It would help us to avoid, let's go back here to SPY on a different chart to make sure we can understand this. Let's go here to the daily chart. We're going to look here to the hollow candle. And the first thing I just want to point out is that we have stopped going higher on our absolute uptrend, which means when we connect our bear market low back to October of last year, our bounce here in March, we're currently below it. So this is either a massive trap, and yes, I love the word trap because it's accurate most of the time, or this time we're going to be going lower. So we look at the uptrend, we've stopped going up, and now we're below the short-term price or the 50 MA. We got a rejection, and now we're below the long-term price, which means we're pointing down on the short-term and the long-term. So if that seasonality chart is going to play out for the bulls, what I need to see, I need to see daily candle closes back above the 200 DMA, but then we really have to form a weekly higher high. So the first thing I'll be looking for is going to be 2 consecutive daily candle closes over roughly 422.3. And this number is going to be important, so please pay attention here. 422.3 is going to be our 200-day moving average or the long-term price. And if we're going to go nonstop up from here, it should be no problem to reclaim that area because we're supposed to go straight up, not looking back. So 422.3, is there any more significance to this number? Let's look to our current our weekly low here going back to September 25th. And this should actually be our low here for the month. So we're going to look at a nice clean chart because it just makes it easy to follow along. 422.29 is exactly the September low. So 422.3, 422.9. Are you understanding how important this number is? It either means that we're going to get a failed breakdown if we're above it, or we got a breakdown because we're below it. A failed breakdown is bullish, a breakdown is bearish. So there is no bull story if we're below 422.3, period. That means that we could be back above our current uptrend, which is roughly at 423. And then we have to move even higher. To reclaim our uptrend, we got to make it to 430. So it's nice that we get back above our 200-day moving average. But for us to actually complete the pattern, we need to form a higher high compared to here. So meaning our dead cat bounce, we got to form a higher high. And you can see the blue lines right there. What does that mean? We have to reclaim the 50-day moving average. So the bulls have to make it go up, up, up. We got to make it to 438. What 438 do to the weekly chart? 438 would be a weekly higher high. Our high so far is 438.14. Also, if we look here to our monthly chart, that would also mean we're back above our August low at 433. And then finally, we've got our July low at 438. I hope you're understanding how important these numbers are. The bulls have to make the chart go up. Basically, they got to rally at 4%. That's a pretty big move. The bulls better make sure they're going to be pushing higher here. All right, so there you go. There's the bull thesis. Meaning, if we keep going straight higher from here, evidence is going to be that we're closing above the 200-day moving average for 2 days, or the gray line you can see here. Then we have to close above the 50-day moving average for 2 more days. And then we have to close the month out higher. Why? Look, we're supposed to be closing at the high of the month. If we're currently delayed, that might not happen. So we have to make sure we pay attention to the weekly chart. All right, here's the bear thesis. Let's go through it. This one has momentum. It's more likely. The risk reward just isn't as good. And I'll tell you the reason why. The reason why the risk reward isn't as good is just because for the bears to know that they're wrong, they're going to have to wait until we get all the way up here to 438 or print that monthly higher high, which means they're going to have to suffer through a 4% rally, and then they're going to know they're wrong. That's the same thing that bulls had to go through as we declined here. I kept mentioning over and over that if we print a monthly lower low, that's a long way from where we are currently in July. Started getting bearish in July, and I mentioned that we're going to have to suffer a decline of 5 to 6% before we get evidence, not feelings, not how we feel, but evidence we're wrong by printing a monthly lower low, which would lead to lower highs and lower lows. So we had to suffer through a 5% decline. It was not fun. The bears are now going to have to suffer through that exact same thing. However, there's a cheat code for the bears. So the bear thesis can get more momentum if a few things happen. So the thing I'd be looking for would be that, first of all, they got a weekly candle close below 422.29. They have that bearish engulfing weekly candle. So if we print a new low of the month by getting below 420 and close below there, more evidence. We can easily set our stop now at 422, 423. So if the bears are able to make a new low of the month, that would be bearish. If they close the week out red again below this weekly candle, I would assume we're either going to be right on our 50 weekly or we're going to be below it. And then the next stop is 392. That's getting awfully close here to 386. So if the bears are able to close the month out, and let me just do a quick check here because I want to see when the last calendar date of the year is. If we go here, October 31st is going to be on a Tuesday, which means that we're going to get a weekly candle close this Friday, and then we get the monthly candle close next Tuesday. So if we close the month below 422, man, I'm wrong. We're not going higher, and we're probably going into some kind of big crash, right? Some kind of 1987 crash, I think. So if we don't go up, clearly that's bearish, and the bears would gather more momentum because the monthly chart, there's clearly a lot of damage here. If we bring our lines back, we would be stopping to go up. We would be at risk of falling back below our downtrend. And we look to the weekly chart, bearish engulfing, closing at the low of the week, likely going to get continuation. And then we look at the daily chart. And the daily chart, we're below the 200-day DMA. This is where forced selling happens. It happens below the 200-day moving average or the long-term price, because a long-term price is supposed to be strong support. So now that I've laid out both the bear and the bull thesis, I think that's it. So I'm going to ask you one more time, if you could please consider subscribing to the channel. If not, a video should now be queued up here on the left-hand side with my deeper thoughts from last week. And you can see exactly what I thought would happen, where I was right, and more importantly, where I was wrong, because I want you to pay attention to that. Finally, if you've enjoyed what you've seen, if you want to come join me, Justin from YouTube, for 14 free days, you can go to our website at thealgo.com to trade with me. If you don't like what you see, no problem. Cancel before your 14-day free trial. You can go back and watch for free on YouTube. No hard feelings. But like I said, I thank you very much for tuning in, continuing to watch these videos. And I very much look forward to seeing you for the Monday opening stream, if not for our regular scheduled upload on Monday night. Thank you so much, and all the best of luck this week.